Good morning, ladies and gentlemen. I'm delighted to welcome you to Finews TV. Today's episode is absolutely worth your time. We are looking back at the stock market performance in 2024, a year that was eventful in many ways and sometimes even spectacular. Gold, Bitcoin and artificial intelligence captured the headlines. But how should investors position themselves for 2025? To discuss this, I'm joined today by two leading investment experts. Gérard Piasco from the Swiss-based private bank Claude Baumann and Dan Scott from the Swiss investment firm Vontobel. I wish you a warm welcome here in the studio. 2024 is coming to an end soon. What were the highlights for you this year, Dan?
Claude, thanks very much for having me on the show. So 2024, I would say, was a very eventful year, a lot happening. But the highlight definitely was on the 10th of July, because that's when I really got to feel the impact of the US consumer that we've spoken a lot about, and how the US consumer has carried global GDP basically this year. But on the 10th of July was when Taylor Swift was performing here in Zurich. And the town was full of Americans. And it's when I understood that the reason it was full of Americans is because it's cheaper for them to fly to Europe and spend the money on hotels and get a ticket to see Taylor Swift here in Europe than it was to actually go to one of the concerts in the US, where on the black market the tickets were so expensive. And in fact, the California Bureau of Work estimates that the 6 concerts that she held in the Los Angeles area employed 3,300 people, and in dollar terms added about 160 million to their income. So from that perspective, it's the US consumer, the strength of the US consumer that has really put off the recession that everyone was telling us was going to arrive.
That was not only a highlight, it was also a surprise, we can say.
Yeah.
Gérard, what were your highlights or even learnings in this year?
I think the learning 24 has been similar to the learning of 23, because I remember at the beginning of 23, as at the beginning of 24, the common consensus was the US economy will grow much less, and there's a risk of recession. And I said, no risk for recession, because the US is a solid economy. Beginning of 23, I said it. Beginning of 24, I have to say it again. It's just underestimated. The learning of 24 was the same learning as the learning of 23, that the US economy, the biggest economy of the world, is always underestimated. And I think it's again underestimated. And that's why we had this huge performance. Not the only reason why we had the huge performance of US equities. Earnings growth was great. US companies were doing much better, profitability better. But the learning is, don't underestimate the US economy.
Now in 2024, we had another very special event, the second term of Trump, or let's say the re-election of Donald Trump. And we saw a very euphoric market after his re-election. How do you see that development now, if we look ahead to 2025?
And there was a clear risk, if Harris had been elected, that corporate taxes would have been increased at the end of 25, beginning of 26. This risk is away, and the market reacted, I think, very rationally. With an outperformance of US equities versus the rest of the world, because the outlook is that the US tax rate will stay low or even be reduced again after the beginning of 26, depending on what we will see from US Congress, particularly in the coming quarters. And therefore, that was positive. Then, second, America First as a policy in general will have other consequences beside taxes. Tariffs are on the table. Tariffs will make it more difficult for non-US companies to compete. It can be compensated via lower currencies, as we have seen with China, for example, after 2017, but therefore capital has flown from the other countries into the US since actually beginning of November even more, but it started before. And that makes sense. That question is now, is too much consensus already here in the prices? And I think that's what we have to find out in the first quarter of 25.
Then how do you assess the impact of Trump on the markets?
Well, I think it would be great for the show if we had a big disagreement now, and I'd say Trump is going to be terrible for markets. But unfortunately, we agree. You know, there's a lot of enthusiasm for what we've learned even since the election. I mean, I think the first takeaway was that we had a sweep in Congress, means that you have a president-elect who is going to be able to push through their agenda, at least in the first 2 years, while they have control of Congress. And so that it's not going to be a lame duck presidency, which was actually the base case going into the election, was that there was, you know, either Harris or Trump would have a lame duck presidency. And so that's not the case. They're going to be able to push through their agenda. And what we see now from the nominations is that actually it's going to be a very sensible agenda, because it's not necessarily fiscally profligate, which was also one of the things we were worried about, ballooning budget deficits. But they're now talking about trying to achieve a 3% budget deficit by cost cutting elsewhere. So you have deregulation, a potential extension of the tax cuts, and even lowering taxes further. And then you have spending programs that are still ongoing, you know, hundreds of billions on Inflation Reduction Act, on the CHIPS Act, and then on top, all these measures that we're expecting from the Trump administration. On top of that, you have a central bank that's still cutting interest rates. So really, it's difficult not to have a positive view on risk assets and not want to go risk on US assets. It all looks very dollar positive at the moment.
We have been talking about surprises. Were you taken by surprise by the re-election of Trump?
I saw his rally in New York. New York, he could not win. He knew it, but in the Madison Square Garden Arena, he organized this huge rally, and the last 10 minutes of a 6-hour event, by the way, 6-hour event, was really interesting, because I saw a different Trump, more reasonable Trump, less vanity than before, and I thought, maybe he's underestimated, maybe he's more popular, and over the screen, he is coming great, right? And this we could not say from Harris, and therefore I was not completely surprised that he won, but I was surprised by the amount the Republicans gained in the Congress, that particularly in the House. I think that was a big surprise.
Then was it more a perception of Europe that Kamala Harris would have a serious chance?
No, I don't think so. I think it wasn't clear to anyone really what the outcome this time round would be. I think you could find just as many that were saying, oh, clearly it's going to be Harris that wins this presidency, as you would find Trump supporters that say clearly it was Trump that's going to win. And I actually woke up at 3 o'clock in the morning to watch the first TV debates, which just turned Trump into a laughingstock, with everyone running around with their, you know, eat the dogs, eat the cats memes. And at that moment, you would think, okay, it's going to be tough for him to pull this one off, especially once you saw the amount of money being spent by Hollywood celebrities endorsing Kamala Harris, that she would win on the coolness effect. But in the end, we know what the result is. So no, I don't think it was very clear at all. And again, our base case also was more around Congress. There was where we were thinking likely it's going to be a gridlock situation. But this red sweep, I think, was a bit of a surprise.
Would you gentlemen maybe disagree on what assets or asset classes, which sectors will be performing in 2025?
Yeah, I mean, we have been overweight US equities for a long time, actually more than a year, particularly against Eurozone equities, against emerging market equities, against actually the rest of the world. We had not to change it. That's why I said before, you have rather to think, when is the optimism too much, right? Because it's getting consensus more and more. But as long as the earnings growth is so superior, I think it still makes sense to overweight US equities. On the other hand, the dollar has improved against the Swiss franc particularly, but against the euro before already, after November 6th. And here it will become interesting next year how a strong dollar is still tolerable for, let's say, US multinationals, and also indirectly for Trump. On the one hand, he likes a strong dollar, right? But if it's too strong, maybe there will be some feedback from CEOs from multinationals. But for the moment, I think it's clear. U.S. equities are the name of the game. We have broadened our exposure to the mid-sized companies, which are more domestically oriented. They have a higher percentage of revenues coming from the U.S. economy directly, which makes sense because it's an economic growth friendly agenda, both from Trump himself and from the Republican Party in general.
What's your view on the stock market in the US, sector-wise, maybe? I mean, if the Democrats would have won, then maybe other sectors would have been favored. How do you see?
Well, very clearly, the deregulation around, expected deregulation around financials is one that's been driving the banking and financial sector stocks in the US. But I think broadly speaking, you know, we are going to see, especially those domestically exposed now starting to catch up, because when you're talking about valuation, yes, on index level, the S&P 500 looks very expensive, but it's really only a handful of stocks that have very high valuation multiples. The 493 of the S&P 500, so, you know, excluding the Magnificent Seven, aren't necessarily that expensive, and the Russell isn't really expensive at all. So we've seen a bit of a catch up, small and mid, since the election, or a gapping down of those big mega caps, and maybe now it's no longer the Magnificent Seven, more the Fabulous Four, but also there, what we'd say is our expectation for 2025 is that you have this concentration risk starting to diminish somewhat as more of the earnings growth contribution to the index comes from the small and mid caps than from the mega caps, or even just the large caps actually should be fine, just, you know, outside the megas. So I think playing the size within the US will give plenty of opportunity to outperform benchmarks. And I think it should be a good year for active managers, because let's be honest, there is hardly any active manager that has beaten the benchmark on US equities in this year. Why? Well, because all of us believe in modern portfolio theory, and no one's going to, you know, put an 8% weight in their equity portfolio on Nvidia. And so if you didn't do that, then you underperformed. And now in 2025, I think as we see a bit of a mean reversion in terms of earnings contribution, it will give a good chance for those active managers to have a good year.
Setting stocks aside, I think there is another element that we should watch in 2025. Bitcoin surpassed the mark of $100,000 this year. Is it still worth to invest in Bitcoin?
I think it's an absolutely interesting addition for people who are willing to take the volatility, because the volatility of crypto assets, Bitcoin also is 3 to 4 times the annual volatility or monthly volatility of equities. I mean, this is what you have to know if you are interested in that. But if you look back 5 years, 10 years, and look at a Sharpe ratio, total return, excess return divided by volatility, it has clearly improved portfolio. So it's an interesting addition, and I think it will continue to be an interesting addition, although we are now at a high mark. That's true. Why we are at this height is because clearly Trump, before the election, has given signals that he will regulate less strictly the crypto environment, crypto assets. Therefore, it has benefited, and clearly also from the launch of the ETFs. So you can invest via the stock market in Bitcoin. Has improved in performance, but you cannot expect every year 150% like we had last year.
But are there any alternatives to Bitcoin that we should consider as an investor in Ether, or is that the same, or blockchain, or?
So I think within the coins, it's the future will tell. Which ones are the surviving coins. I think Ether definitely also has a big ecosphere around it, and not just the coins. So that likely will establish it as a long-term alternative currency, which block also is, Bitcoin also is. And so from that perspective, I think it's established asset class. So I think coins are, crypto is an established asset class now, which means that it should be at least a satellite allocation. I believe in diversification. I think that you should be exposed to all asset classes in order to have good diversification. The question is just to what degree. And right now, I'd say that crypto is a satellite position, but it definitely has a role in a portfolio. And then when it comes to the rest of the value chain, I'd say blockchain definitely does have a lot of use cases, and together with AI, will have an amazing impact on productivity overall. So quite constructive on it. As an investor in listed instruments, I still find it very difficult, though, to find a way to buy, say, the excitement around decentralized finance. I think those companies still need to do a lot of maturing. I think we're in the very early stages right now, and this is maybe not even yet in the private equity stage. This is really in the venture stage. So at this point, I'd say it's too early.
But do you think that tokenization will offer a huge variety of investment possibilities?
Yes, I think.
Not so distant future?
Well, so how do we define not so distant future? I've already started populating my children's portfolios with coins, so and products on coins. So from that perspective, yeah, no, I think in 15 years it will be quite established, and we won't be talking about the blockchain as something separate. It'll just be like the internet today. We don't talk about internet stocks. Internet is just a part of the business process. It's everywhere, and I think the blockchain will be everywhere too.
Another part of our investment universe is gold for thousands of years. And Gerard, you told me you are a gold bug. You said to me, we saw gold also reaching new record marks in this year. How do you assess this development?
I think I've been known as a gold bug for more than 25 years, and I think what really has changed on the demand side of gold with the Ukraine war is how central banks have and still act, and this is the emerging market central banks in particular realized after the sanctions against Russia in 22 that it makes sense to diversify their forex reserves a bit away from the US dollar, which can be blocked at the Fed of New York and in other locations, into something which is liquid and can be moved from one country to the other one more easily, and that's gold. And China has increased gold holdings, Turkey has increased gold holdings, India. Many emerging market central banks are still in the process of diversifying their dollar forex reserves into gold, and that has been a huge factor. Another factor in China, beside the central bank, the real estate market is still in correction. Equity market is very volatile, so Chinese population realized it also makes sense to have more gold in a portfolio. So that was another increase in demand. And I think these two factors are structural in nature. They will not go away short term. And as we know, the supply is relatively limited. Therefore, I think gold, we are now neutral. I think gold makes sense to be part of a portfolio. And we should not forget the geopolitical tensions, right? It's even if it's not Hamas and Hezbollah anymore, or at the moment, and it's Iran maybe more in the future, there's still a lot of tension in the geopolitical landscape, and as a hedge against geopolitical risks, gold has proven itself for many decades.
Dan, are you recommending gold, to buy gold now?
We also just went from an overweight to a neutral on gold. Tactically speaking, though, structurally, we're also bullish gold. It's very clear China's financed its gold purchases by unwinding treasuries. We also see that the central bank demand is what's been driving gold prices. So actually, with the rates coming down, you might have the incremental buyer now be financial markets. That opportunity cost of holding a non-yielding asset, starts to diminish when you can no longer make 5% on your money market fund. So I think that, the 8 trillion that we still have, incidentally, in money market funds starts being deployed to capital markets. And part of that's likely going to go to gold as a diversifier, but also as like an insurance policy for a portfolio. It really is a provider of convexity.
Mm-hmm. Coming back to the assets that are a little bit more modern than gold, artificial intelligence has been also a big theme this year. Was that the hype, like many phenomena in the digital space, or should investors position themselves even more in this topic?
I mean, as long as the earnings which will be published and are published are not disappointing, the higher multiples will be digested by even better earnings growth in the future. But it's true, the growth expected now is relatively high, as a high obstacle, and therefore the concentration is already high. We have broadened the US equity ownership in the portfolio to mid-sized companies, but the profitability is another factor which is so much superior to the rest of the world, also to the rest of the US corporate landscape, that the investments they have done is huge amount of money. But if it's monetized with revenues and earnings in the next couple of quarters, then a correction can be avoided. If not, then clearly it has become a more difficult game than a year ago.
Mm-hmm. Maybe a general question. How much is artificial intelligence impacting your work as investment expert?
So I'd say my work starts with capital market assumptions and then over a 7-year business cycle and then ends up in portfolio construction. And at the capital market assumptions level, AI is now already part of the calculations. In fact, if you read the sell side research, the economists out there will have anywhere between 0.2 and 0.5% contribution through productivity gains from AI baked into their GDP estimates for next year. So it's already real. It's already being used as part of the expected GDP growth, and also from corporate earnings. I mean, I thought if you want to reference it, the Walmart earnings call on the back of their last earnings, where they and publish then in the statement where they actually go through and show you exactly how they're using AI in their business processes and what kind of an impact it's having on their financials. You can see it's also there, like I mentioned before, on blockchain, is becoming endemic. It's becoming a part of a business process. So I think there are definitely pockets of hype where people get very excited about that next AI company, and over exaggerating that element. But what they're underestimating is how it's going to have an impact on the earnings also at Nestle and the rest of industry that manages to utilize it. And the companies that are going to help us utilize it are, of course, the software companies. And I think they're the big first line beneficiaries, the ones that create software applications for us to use then to raise productivity.
Do you use artificial intelligence in your work, Gerard?
I use social and emotional intelligence still more, but I think artificial intelligence is clearly improving productivity. We should not forget everything which can be quantified will have a use case with artificial intelligence, but that's not everything, right? Not everything can be quantified. There's still other element in investing, which sentiment, etc., which is important. I believe that the consumer, and particularly the US consumer, will decide the fate of what we call artificial intelligence applications. It has just started. On the other side, corporate use cases. I just heard that OpenAI has now increased the price 20 times for corporate use of their ChatGPT function, but that's really a much smarter function. The corporate demand side can improve their revenues as well. So we are just at the beginning of the rollout of use cases for artificial intelligence. But at the end of the day, the killer application, everybody's waiting for, right?
Yeah, we have been talking a lot about trends that originate from the US. I also would like to talk about Europe, where many things happen. Germany, France are dealing with numerous problems, and their economies are developing in a more weak way. How would you assess the situation in these two big locomotives of Europe?
Yeah, it's definitely a problem of the big two economies, Germany and France. The hope is that the next government in Germany will become more economy friendly. But I see that a compromise will be necessary if you have another chancellor at the top in Germany. I think the problems of Germany are structural in nature, particularly in the car industry. The competition from electric vehicles from China, which is flooding the world, and particularly a European car market, is too tough to overcome. So they have to rethink their economic structure completely. I believe the world economy is going from manufactured goods more towards the service industry, and that means the US has clearly has a better chance to win this game. France, okay, 1/3 for the far left, 1/3 for the center, and a third of the population is for the far right. So it's difficult to find a government and to improve the economic growth. I think this problem adds to the problem of Europe. So we are underweighted Eurozone equities. We prefer Swiss equities, which are less expensive than 2 years ago compared to Eurozone equities, compared to world equities, because Switzerland has here some really advantages.
Mm-hmm. I think we might have potentially one area where we can at least have close to a disagreement on.
Great.
Maybe I can take you back to your clubbing days and ask you a question. You might remember the year the song Jetzt wird wieder in die Hände gespuckt. Wir steigern das Bruttosozialprodukt was out in the charts.
New wave German.
Yeah. It was the same year that Helmut Kohl came into government. And at the time, we had an environment of deregulation, structural reform, investments into, or at least supporting, capital accretive investments into the economy. And we have an election this year, in 2025, this coming year. Sorry, as an investor, I'm always thinking 6 months ahead. So, we have German elections. And I think right now it seems clear, I mean, take that with a pinch of salt, but right now it seems clear that there's going to be a big shift to the right. And so I think if you're going to have a majority CDU government who knows or who has this mandate from the people to fix things, because the frustration in Germany is palpable, everyone's frustrated with the current situation, then there might just be that opportunity for Eurozone equities, and Germany in particular, to be the trade of the year. Because you can, at the moment, get very high quality companies that are trading at a discount to book. And some of these companies aren't necessarily even 100% exposed to the German economy or to the Eurozone economy. They're international champions. And so I think from that perspective, there is, as we would say it in our parlance, the risk skew is clearly to the upside on Eurozone equities, just because the sentiment is so negative.
But politically move to the right, as you mentioned in Germany, this could also happen in France. Do we have to worry Or do you see a slightly different scenario there?
No, I wouldn't be worried. I think with what we've heard from the Front National has been they've understood that they need to not be socialists. They need to be more capitalist to win support from the business side. And so what they've been saying on economic policy has been fairly rational. And remember when Meloni was elected, everyone thought, oh, this is going to be terrible, and in fact it hasn't. In fact, Italy's been the star. It's been outperforming. Its GDP growth has outstripped German GDP growth over the last few years. And domestically, not everything, but a few things have been fixed under the Meloni government. So this shift to the right hasn't necessarily been the disaster that many have prognosticated.
Yeah, in fact, this was for me one of the biggest surprises in 2024, the performance, the emergence of Italy under the Meloni government. We also saw in the financial sector very interesting developments. UniCredit that wants to buy Commerzbank, and even if this would not be enough, they also want to take over the third pillar of the Italian banking sector, Banco BPM. How do you see that developments? Is this the necessary push to bring more dynamism into the European banking sector?
I would say, first of all, the financial sector in Europe has outperformed the broad European market hugely this year, which was clearly also coming from net income margin improvements. You could invest in bonds and gain more than before. That was a positive for banks. On the other hand, yes, if we have really the possibility to create cross-national, cross-border banks, mergers, we have too many banks in Europe, from, I don't know, 20, 25, in each country, 2 or 3 big banks. You don't need in every country 2 or 3 big banks. You need maybe 1, maybe not even in every country. So cross-border mergers with cost cutting and improving productivity and therefore profitability as well would be a great positive for the Eurozone, for the European equity market as such. Question is, do the governments allow it, right? And this is the general question. Do the single countries want more real Europe in the sense of economic development and common financing or not? Same for bond issuance, right? This is a big feature, a big question of the next, I would say, 2, 3, 4 years. If yes, that would improve Eurozone equity performance clearly, but the benefit of the doubt to give is not as easy.
Then what do you think, European countries, are they willing to have more Europe?
Well, look, I think for a politician, it's very hard to sell that to the domestic electorate. And that's why it hasn't been happening. That there isn't enough consolidation is clear. I mean, look at how many airlines we have, how many telco companies we have in Europe, and banks also. So yeah, there's a clear need for consolidation. We have on each of those industries, we have a multiple of like 4 or 5 times to what the US has, which is an even bigger market. So no, the need for consolidation is very clear if we want to keep up with the profitability of the US counterparts. But again, difficult to sell politically. I think what the catalyst could be, though, is the crisis we are headed towards on government debt. And if all of a sudden governments understand that they're having issues, having new issues, and that spreads are, wandering in the wrong direction, they might need to start selling some state assets. And I think that might be a catalyst to actually be supportive of consolidation. And I think, G7 in general have an issue. All these developed nations have an issue with their debt levels. They're going to have to resolve them. And the only way to resolve it is to either have superior, strong economic growth so that you have the tax revenue, or you let inflation run your debt away. Or you just tax highly. I think we're likely going to see a bit of each. I think we're going to see inflation running above the official targets. So not at 8, that's dangerous. But at 3%, that's wonderful. Inflate that away a little bit. GDP growth, we're going to try with various stimulus programs. You see it in China as well. What 5% of GDP we currently have in terms of stimulus, and people are still saying they're missing the big bazooka. and the programs in the U.S. So, I think that could be the potential catalyst. What is Europe going to do to stimulate, or how are they going to be able to finance their debt? And I think some consolidation might be the one magic answer that they come up with.
You raise a lot of questions, and in this context, where is Switzerland? What is Switzerland doing? I mean, before, Gerard, you mentioned that you prefer Swiss equities, but take it in a broader context. What's the role of Switzerland?
The island of stability in a every year more chaotic world, and also more chaotic Europe. Unfortunately, actually, Switzerland is the gem within Europe. We see that with immigration. It's from the US, from the UK, from Germany. Real estate market is benefiting from these trends. The Swiss franc is strong, and the valuation of Swiss equities has been reduced in the last 2 years by about 20%. So it's competitive. Clearly depends on the restructuring of some big companies too, but they have made changes in their management, and therefore in their strategy. I think the chances are better now. Switzerland is the gem within Europe. The Swiss franc is the real gem for the Europeans coming here, and we have some great companies which are on the way to be restructured, re-innovated maybe even, which is necessary with the management changes they have decided. That's promising. I think that's promising for the future.
I would like to dive even more into these gems. I mean, you mentioned some companies. Could you also give us some names?
Yeah, I mean, in general, the consensus is now we have better economic growth in the world, and you should overweight cyclical companies against defensive companies, healthcare and food companies in general. And we have some in Switzerland, as we know, all these names have been, I would say, neglected. The valuation has come down in the healthcare and food sector globally, but also in Switzerland. If something goes wrong, right? If the consensus is not right, and the consensus is relatively mature, I mean, it's not new. We have seen these trends for many months now. Then you have an additional factor for the defensive companies of Switzerland to be again demanded stronger from global investors, and I think this should not be underestimated because it's not consensus.
Yeah. The strong Swiss francs that you have mentioned is a very important element in the markets. At the same time, we have new speculation now that the Swiss National Bank might introduce, maybe not tomorrow, but in a couple of months, or maybe in 2026, negative interest rates. How do you assess this scenario, and what would be the impact for the markets?
Look, I think any central banker needs to see negative interest rates as the worst case, or the absolute measure of last result, because it really is nonsense to have negative interest rates. However, the reason why they were used or utilized in the first place is because no one wants to see a Japanification of their economy. So going into a deflationary spiral is what you don't want. And I think that there is maybe that element of risk in Switzerland, that we have such low inflation or deflation, that we move into deflation. And so from that perspective, coupled with the fact that the Swiss franc is strong, will move the SNB to move, right? I mean, the consensus is that we're going to have further rate cuts from the SNB, and the only question is how much and how steep those moves are going to be, because Swiss franc has been an issue for corporate earnings.
Mm-hmm. Yeah. So maybe to come to a conclusion and to offer some takeaways for our audience, I would like to ask you a few brief questions, and maybe you can also give me a brief answer. I hope that you agree to disagree, maybe, so that we have more findings. What should we watch for in the US under Trump?
I mean, clearly the tariff issue is the one which has a lot of unpredictability. Mm-hmm. How much tariffs will be increased? Is it more on the deal maker Trump going big into negotiation, and then like in 2017-18, then a compromise comes out. So that's the big known unknown, so to speak, in Donald Rumsfeld's term of we have known unknowns, but also there are some unknown unknowns. The unknown unknowns are certainly coming from the geopolitical environment. I see the Mideast not settling to stability in the next couple of months. There is actually a chance, historic chance, maybe to try to change the government in Tehran, right? In the Western interest, in Israeli interest. So that could be a source of instability, which is not priced in the oil market, for instance, not priced at all. I believe also that what is important is to really challenge the consensus in the equity market as well, which I just mentioned with the defensive sectors. There is a strong consensus of strong growth. And the forex market. I mean, the forex market is getting interesting. We have seen volatility in the last 12 months, both sides. First, the dollar was a bit lighter, softer against the franc, then dollar stronger again. I think volatility will be a constant issue in the markets 25 more than 24.
Trump is not only a politician, he was an entrepreneur, or what shall we watch on the Trump?
So I think the important thing is the amount of what the market is already pricing in, that it thinks it knows is going to come our direction. And then if it doesn't come that way, there's going to be some volatility. And I think that there is potential downside for US equities if we don't get some clarity on where corporate tax rates are going. Do we just get an extension? I think would already be negative news. I think the market's already pricing in further cuts on corporate taxes. And so then multiples can maybe look a bit rich from that perspective. So tax cuts, I would say, is the number one. Had they been phased out altogether, his tax cuts that he brought from his first term, that would have been a huge fiscal drag on the US. And we would have had a completely different positioning. So that's topic number one for us. And topic number two around tariffs, I think it's going to be how they're nuanced, not if they are, because they definitely will be nuanced. He's not going to introduce taxes on all the stuff that those people that elected him for, are buying on Amazon, because that's just going to drive up inflation in the U.S. And so therefore, I think he'll have some targeted, saber rattling, measures against Chinese cars or whatever it is that he's going to score out. But I think he's going to be very targeted. And a potential casualty stuck in the middle could be Europe. And so tariffs are definitely worth watching, not just for its effect on the US and inflation there, but also its second line effects elsewhere around the world.
Maybe one thing not to forget is the bond market here, right? I think the bond guardians, or vigilantes, you call them also, is a kind of measurement for the Trump administration in the next couple of months. We have been as low as 3.7% in the 10-year Treasury yield. We moved up to 4.5%. Now we're fluctuating between 4 and 4.5% because the bond market is really waiting for exactly the inflationary impact of the Trump agenda, of the Republican agenda, and could be the one who is influencing Trump and the Republican Party in his ideas, and not to exaggerate would be good.
Maybe coming to an end, very important, what should investors avoid in 2025?
I would say exaggerated bets. A diversified portfolio, including private markets, including Swiss assets, but also with a clear focus on not only large US companies, makes a lot of sense going in 25, and including, again, gold because of the geopolitical risk potential.
And you?
So I think the biggest risk is not being exposed to capital markets. History shows us that the right time to invest is now, always. Even if you bought the market at all-time highs, you're still outperforming, then if you weren't invested. So from that perspective, it's about how you go about that exposure to capital markets. And I would say at the moment right now, for me, the risks are twofold. One, at the lower income bandwidths of consumers, because they, if rates don't come down fast, are increasingly in difficulty. You see it in credit card delinquencies, you see it in auto loan delinquencies, you see it in published numbers at McDonald's where there's a trading down even at McDonald's in terms of products. So at the lower income level exposure, that's a danger. And something that's worth continuing to monitor is US commercial real estate. Also there, the potential for further insolvencies and then a domino effect into the economy is still very real. And in fact, with vacancy rates in prime cities like New York and San Francisco of like 30%, that's historically high, those developers that need to now refinance their debts but have that much of a cut on the income side, they get constrained. So there are some areas to watch out for, but overall, we're quite positive going into 2025.
Okay, nevertheless, the right time to invest is now. To conclude, I would like to say thank you, Gerard Piasco from Claude Baumann, Dan Scott from Frontobel. I wish you a very prosperous 2025. Thank you.
Thank you, Claude.
Thank you.